You need to prepare for a hard landing as the risk of a recession is on the rise, according to the latest research from the Fed. According to this chart, the probability of a recession in the next 4 quarters is at the highest level we've seen in nearly 51 years. Per Jonathan Payne, the author of the Payne Report, the metric we want to pay attention to is the 3-month versus the 10-year yield inversion chart, which has preceded every recession since 1960, where on average a recession has followed in 16 months. On top of that, you have famed investor Michael Burry, you know, the one The Big Short was all about, the one who predicted the last crash, also predicting a recession in 2023. And on top of that, also expecting another inflation spike because he believes that the Fed is likely going to pivot, pause, and possibly offer some quantitative easing, which in turn is going to cause inflation to once again rise. So what does all of this mean for the housing market? What does all of this mean for you as a homeowner out there? Well, in today's video, we're actually going to talk about what the Fed is saying, what the Fed is planning to do, and some predictions, what's going to happen with interest rates, and in turn, how that's going to affect the housing market in 2023. With all this recession talk, everyone predicting a recession, it would likely be the most anticipated recession in U.S. history. According to forecasters surveyed by the Federal Reserve Bank of Philadelphia, the probability of a downturn in the next 4 quarters is sitting at more than 40%. This is the highest reading since 1975. Also, economists polled by Bloomberg see the chance of a 2023 slump at 65%. On top of that, you have a model created by Bloomberg Economics putting the risk of 100% with a start date of September. At the same time, you have the Fed's Esther George seeing rates staying high until 2024 as other Fed officials see higher rates ahead for some time. So the real question is, will the Fed pause? Will the Fed pivot? Or will the Fed continue to raise the Fed funds rate, trying to stamp out inflation and ultimately send the economy into a deep recession? Based on the latest Fed minutes, no participants anticipated that rate cuts would be appropriate in 2023. And as we've discussed in other videos, the Fed has anticipated raising the Fed funds rate on average to 5.1%, and we're currently sitting at 4.5%. So the thought out there is that the Fed is going to continue to push rates up, which is going to send us into this hard landing, this big recession, if you will. And if we know anything about the Fed, they always go too far for too long. If we look back into 2020, when the Fed was talking about inflation, calling it transitory, they held that stance for much too long, even though inflation was continuing to run out of control. So if the Fed does the same thing on the other side, if the pendulum swings all the way to the other side and the Fed continues their aggressive stance, keeps rates high, then yes, that's likely to help bring down inflation, but it's also likely to send the economy into a recession. Based on the latest data, the U.S. economy added 223,000 jobs in December, which was actually higher than expected, bringing the unemployment rate down to 3.5%. And this is one of the metrics that the Fed looks at when deciding whether or not how aggressive their stance is going to be with regards to the Fed funds rate. And even though month over month we're seeing a decline in the number of jobs added, this is still positive news for the Fed because it shows that unemployment is still doing much better than expected. But with that said, we are starting to see some chinks in the armor, as we are seeing month over month declines in the number of jobs added. On top of that, job openings are also starting to show a decline, even at a time when wages are still increasing. So what does all of this mean for inflation? What does all of this mean for the economy? Well, as we've shown you before, based on this chart here, we should see inflation continue to go down, as inflation is calculated by adding the last 12 months of monthly inflation numbers. And as we've seen over the last couple of months, monthly inflation is continuing to go down based on last year's numbers. In fact, we're supposed to get December 2022's inflation numbers this week, which is likely to also show a decline, which in turn is likely to send our core CPI lower than the 6% that we're currently sitting at. And on top of that, this should continue to show the Fed that what they've done is working. According to Adam Posen, a former Bank of England official, he sees U.S. inflation dropping to a 3% handle by the end of 2023, saying that it's already baked into the data. Posen said the key question for the outlook was how fast inflation might go down from around 3.3% at the end of next year to the Fed's 2% inflation target. So Posen is looking at the numbers thinking that we're going to have a 3.3% inflation rate by the end of 2023, which is still quite a bit higher than the Fed's 2% target, but much better than the 6% that we're currently sitting at. And he goes on to say, the related question was how high the Fed would need to raise its benchmark interest rate above the high end of the range reading of 5.25% that the Fed expects in February to get it there. So we know that inflation is already trending lower due to the Fed hiking the Fed funds rate on top of improvements in the supply chains, in addition to the improvements that we should see from falling rents. Based on the way the Fed calculates rents in the inflation numbers, they're currently reading artificially high. So as those numbers adjust, it's going to cause a further decline in inflation. And as we've discussed many times on video, as inflation goes down, interest rates should follow. Actually, I want to stop right here and ask that you smash that like button if you appreciate the time and effort and energy I put into these videos, as not only does it help me accomplish my goal of helping more home buyers, it also helps the YouTube algorithm and helps get the video in front of more people. So what does all of this mean for the housing market as we head into 2023? We ended the year with pending home sales declining for the 6 consecutive months, with pending transactions dropping nearly 38% year over year. With that said, the housing market cooldown is likely to continue for some time, as housing affordability continues to be one of the main drags on buyers actually being able to move forward and purchase homes. So I do think real estate in 2023 is going to look a lot different than 2022 in the number of transactions actually taking place, in the number of homes actually closing escrow. And while interest rates are likely to decline, we're likely to stay somewhat high with regards to rates compared to the last couple of years. As of today, interest rates are currently sitting around 6.25%. And I believe as the latest inflation data comes out, it's likely going to meet or possibly exceed what most economists out there are expecting, which is going to be a positive thing for interest rates. And I believe that it's possible that you're going to see interest rates, 30-year fixed rates, trading somewhere in the 5% range within the next couple of months. Now, I'm not saying the interest rates are going to be at 5%. I'm saying the interest rates are going to start with 5%. So it might be 5.75%, or it might be 5.5%, or it might be 5.9%. But the idea here is that interest rates are going to be lower than they currently are, which is going to motivate some buyers out there to get off the fence and make that move as interest rates trend down. On top of that, it's going to cause some sellers to get off that fence, put their properties on the market, be willing to make that move, as there's a lot of people out there at the moment wanting to buy property but unwilling to do so just because they're currently sitting on a super low interest rate. And in turn, if they buy something else, they're going to be paying more money for that property on top of paying a higher interest rate. And because of that, at the moment, we kind of have this gridlock between buyers and sellers. And that's why inventory continues to sit at super low levels. And I expect this to continue for the next couple of months. I don't see a lot actually happening in the real estate market until the middle of February, maybe the middle of March, when the spring selling season starts to heat up. And while I'm super bullish on housing, super bullish on owning housing long term, I think the next couple of years of owning real estate is going to be more or less a sideways movement. While some areas move sideways and some areas decline by maybe 5 to 10%. And a lot of it's going to have to do with where you're located. As I always say, real estate is local. So depending on your area, you might see a bigger decline or possibly a more stable real estate market than other areas across the US based on what's happened over the last couple of years. If you were in one of these markets that saw huge price growth, just crazy appreciation month over month, you have a lot of new construction in your area. You had a lot of these big companies like Zillow and Open Door buying property. You're more likely to see a bigger decline than those markets out there that didn't appreciate the most. You know, there are areas in the country that didn't get the crazy appreciation like you saw in Austin, Phoenix, and Boise. And those areas are likely the ones to remain the most stable over the next couple of years as the economy suffers through a recession. Now, if you are thinking about buying a home but not sure if now is the right time, but you're trying to prepare, well, I've actually taken the time to create a first-time home buyer course with over 50 modules to guide you through that process. So if you want to become an expert first-time home buyer, do me a favor and check the link below. So the question is, if you're a buyer out there wanting to buy a property, should you pull the trigger or should you wait for lower interest rates and potentially lower house prices? The reality is you shouldn't be trying to pick a top or a bottom in the market, trying to buy with the lowest interest rate possible. You should be buying when it's the right time in your life, when the payment makes sense to you, but you absolutely need to have a longer term time horizon. And the reason for that is because we saw crazy appreciation over the last couple of years. And on average, the last 65 years, homes have appreciated nearly 4.6% in the United States. And when you see 30 to 40% appreciation in just a 2-year period of time, you actually need that number to moderate, to go sideways, potentially even come down a little bit to get back closer to that trend. And I honestly believe that's why you're likely to see home prices move sideways for the next couple of years. So while I don't believe there's a rush to actually go out there and buy a property today, I do believe that owning property and buying real estate is the key to long-term generational wealth. But with that said, you have to be buying when it's the right time for you and not worry about what the Fed is doing or what the media is saying.